Bloomberg News.
Our next guest says that the U.S. is already in recession and a bailout package won't make any difference. He's a man who actually travels the world. Marc Faber, Managing Director, Marc Faber Limited, and editor and publisher of the Gloom, Boom, and Doom Report. He joins us on the phone from Thailand. Marc, good morning.
Yes, good morning. How are you?
I'm well. I want to ask you about the prospects of this bailout plan. You don't like it. You think it's insignificant, correct?
No, I don't think it's significant, but I think it should be expanded because I think, to be fair to all Americans, Mr. Paulson should buy out all the holders of NASDAQ stocks in year 2000 at where they were when the index was at 4,500, to be fair to everyone. So all the Americans could sell him their stocks, which they bought at high prices. And also he should buy all the homeowners' homes at the prices which they paid for. And he should buy your auntie and uncle and mothers and father's stocks at the prices they paid for. That, I think, would be very fair.
Why aren't they then, in your view, doing that?
Well, basically, in Europe, we have restructurings in different countries, but they're not buying assets at overvalued prices. I think the issue here is either we have, as is broadcasted on one of the business channels, free market capitalism, where prices move up or down, or we move into a planning economy. But if we move into a planning economy, it should be equitable. In other words, all people should be bailed out, and not just a few people.
You know, in terms of, you know what the arguments are, Marc, and I pause for a moment because the debate goes back and forth. There are some folks who say these firms are too big to fail. We can't let that happen. And at this point, there aren't many other choices. I mean, do you not agree with what we hear from Ben Bernanke and Treasury Secretary Paulson that, if we don't do this, we risk, the economy really going into a tailspin?
Precisely. I think this is precisely the problem of high inflationary times, that there is a huge concentration in industries, and then companies become too big to fail. And I don't understand that the government continues, and especially the Treasury and Mr. Bernanke continues to encourage consolidation in the financial service industry. They want to make essentially everybody too big to fail. And a free market has thousands of market participants, so if one disappears, and that is the basic tenet of capitalism, that weak participants disappear,
right,
and strong ones expand.
Marc,
and if you have this concentration, it's very bad for the system.
Marc, just 40 seconds before we have to take a break. I mean, how do you balance letting capitalism do its thing, while at the same time not letting firms get too big so that we can't afford to let them fail, to get to this point again? I mean, how do we balance that going forward?
Well, I think what should be done, also in the case of Freddie Mac and Fannie Mae, is that not only the shareholders take a haircut, but obviously also the bondholders. And I think if banks fail, as was, let's say, in the case of AIG, the government took over AIG.
Right.
And quite frankly, I mean, I have no investments in Lehman, but I don't think it's particularly fair,
right,
that Lehman was allowed to fail and AIG allowed to survive.
Marc, hold on. We'll come back. Marc, you were just talking about AIG and Lehman, about how things weren't fair. Let me let you continue here.
Well, I mean, basically, I have no investments in AIG and I have no investments in Lehman. But as an outside observer, I wonder, why was Lehman allowed to fail when AIG was allowed to be bailed out? And somewhere, this is kind of a market that is very manipulated and inconsistent with a market economy. I have to, however, stress that the bailout of AIG was structured the proper way. The shareholders lost essentially most of their money. And that's the way the Treasury should go about bailing out financial firms. They should lose most of the money, the shareholders and also the bondholders. And the Federal Reserve and the Treasury and the government should get the majority ownership of these institutions, so they have some upside.
Mark, Eric Schatzker here. Let's assume for a moment that the bailout package that's going to the Senate tonight gets passed and then gets passed in the House. What do investors need to worry about going forward?
Sooner or later.
Pardon me?
For sure it will get passed.
Right, so what do investors need to worry about going forward? What should they be watching for? What should they be alarmed at if they see it?
Yeah, I think that's the most important question for us, because we're here to try to make some money, or at least to preserve our wealth. I think the markets are very oversold. Emerging markets are very oversold. The U.S. market is very oversold. And traditionally, markets have bottomed out somewhere in October. So my view would be you shouldn't short stocks right here, and they can rebound into March of next year. But basically, the bailout package is deeply flawed and is arbitrary and is unfair to the typical household in the United States, because a typical household, if you're an individual investor, you have a business and you went down the tube, or you bought stocks that went down, you're not going to be bailed out. But the financial sector that abused, to a large extent, leverage, they are going to be bailed out.
I just want to make sure I heard you correctly. So even though this package is flawed, we may not see the flawed effects of it for several months, and as a result, stocks could rally, in your opinion, until March?
Yeah, I think stocks could rally somewhat here. Although I wouldn't play this rally, I think I would rather sell on strength.
All right.
I think more important than the bailout plan will be next year's economy. And I can tell you, in my opinion, the global economy is going into a slump, but a bad slump.
How bad, in your view, Mark?
Well, I think that, relatively speaking, because, I mean, to put it in very simple terms and standardize it, since the U.S. hardly produces anything, the U.S. will be affected less than the producers for the United States. Say, in the U.S., if consumption goes down, it's not the end of the world. Mm-hmm. Americans will just become a little bit slimmer, and that's good and healthy. But let's say for the rest of the world that produces for America, the implications are going to be very dire, as well as for the commodity producers.
All right. So with that in mind, Mark, we've got about a minute and a half left. I'm looking at your note, and you're saying for investors to put about 20% in shares, 10% in gold, the rest at the present time in U.S. Treasury bills. That 20% in shares, where are you finding opportunities around the globe in the equity markets?
Well, first of all, I think that since, I mean, if we look back 2002 to 2007, everything outperforms the U.S. 2008, the U.S. begins to outperform foreign markets. It goes down, but less than China, less than India, less than Russia, and so forth. And I think this outperformance of the U.S. will continue for a while. In the meantime, if you look at emerging economies, in particular in Asia, the financial conditions in Asia are actually quite good. The banks are rock solid, for the simple reason that most of them were too dumb to understand CDOs, so they never bought them. The Lehman salesman could never sell them anything. So they are actually in a financially very good position. The Singapore banks are rock solid. And so, relatively speaking, I think that as an investor, I would look at this weakness in emerging markets as kind of an entry point. Of course, I wouldn't invest 100% of my money in emerging markets now, because I think they'll go lower.
Right.
But we have a lot of companies that yield 5 to 7% dividends.
Okay. All right. On that note, we're going to leave it. Mark, thanks so much. It's always good to get your thoughts on things.
Well, it's my pleasure.
Take care now. Marc Faber, Managing Director of Marc Faber Limited and editor and publisher of the Gloom, Boom, and Doom Report, joining us from Thailand.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP